Welcome to Iron Financial. I'm the lead analyst, and today we are looking at absolutely the biggest seismic event to hit the media landscape in a decade. We're talking about Paramount's colossal $110 billion acquisition of Warner Bros. Discovery. Now, if you're new here, our mission is to help you forge a stronger portfolio and cut through all the market weakness out there. So let's set the macro stage before we break any ground today. Right now, the market is historically volatile. Capital is incredibly expensive, interest rates have completely reshaped the cost of debt, and legacy media companies, well, they are in a brutal knife fight with big tech just for sheer survival. Today's explainer is a total top-to-bottom teardown of this specific deal. We need to figure out if this new corporate megastructure is built to last or if it's destined to completely collapse under its own weight.
And hey, I'm the Market Skeptic. Because let's be real for a second, Wall Street absolutely loves to sell us a shiny new skyscraper. But it's our job to go down into the basement and check for cracks in the foundation. Is this just typical Hollywood hype, or is it actually a fundamentally sound asset?
That's exactly what we are going to drill down into today. We've got the SEC filings, we've got the Q1 2026 earnings reports, and we have the definitive merger agreement. So grab your hard hats, let's get to work. Okay, so here's the headline architectural plan. Paramount Skydance is swooping in to acquire 100% of Warner Bros. Discovery. The offer on the table is $31 per share in cash for all outstanding WBD shares. Now, on the surface, for retail investors currently holding WBD, a cash buyout sounds like a rock-solid concrete floor, right? You get your payout, you completely mitigate your downside risk in a shifting media landscape, and you just walk away cleanly.
Well, hold on a second, though. Before we start popping champagne over this $31 cash buyout, let's shine a massive, glaring spotlight on WBD's operational reality in the first quarter of 2026. Guys, they just posted a staggering $2.9 billion net loss. I really want to repeat that, a $2.9 billion net loss in a single quarter. Think about what a loss of that magnitude actually means for a company's operational liquidity. It means you are literally burning the furniture just to keep the house warm. You're bleeding capital that desperately should be going into new content or debt reduction. So why on earth is Paramount paying a premium for a property that is currently hemorrhaging cash at this rate? That right there is the core conflict of this explainer. We really need to figure out what Paramount actually sees in this wreckage.
Well, here is our inspection blueprint to figure that out. First, the $110 billion blueprint. Second, the load-bearing pillars. Third, cracks in the foundation. Fourth, the $33 billion wrecking ball. And finally, we'll wrap it up with our iron financial verdict.
Market Skeptic, let's tear these financials down piece by piece. We want no fluff today, just the pure structural integrity of the numbers. Ultimately, this is the burning question for every single retail investor watching right now. Is this $31 per share buyout a rock-solid foundation to invest in right now, or are we just buying a condemned building right before the demolition crew arrives? Let's get into it.
Section 1. The $110 billion blueprint. Let's examine the actual merger mechanics.
They are talking about forming a next-generation global media and entertainment company, basically combining the world-class studios of Paramount and WBD into a so-called Hollywood champion. And look, the math on this deal is heavy-duty. Paramount is valuing WBD at an enterprise value of $110 billion. That represents a multiple of 7.5 times their fully synergized 2026 EBITDA. Plus, they are actively projecting $6 billion in operational synergies.
Okay, I'm going to need a detailed explanation here. $6 billion in synergies is a massive, massive claim. Wall Street models are an absolute graveyard of failed synergy promises. How exactly do you extract $6 billion from this structure without tearing the whole thing down?
Well, it requires a brutal, highly systematic integration. You don't just merge brand names. You literally rip out duplicate tech stacks. Instead of running Paramount Plus and Max on entirely different back-end infrastructures, you have to migrate to a single unified streaming architecture. That alone saves hundreds of millions in cloud computing and engineering costs. Then you consolidate global real estate. Selling off massive redundant office spaces in Los Angeles, New York, and London. Finally, you eliminate overlapping corporate overhead, which, let's be honest, is just a polite corporate way of saying massive cuts to middle management, marketing teams, and legal departments. It is highly, highly execution dependent.
I'm incredibly skeptical they can hit that $6 billion number without severely damaging the core product. But what really catches my eye on this blueprint is that 25-cent per share quarterly ticking fee. What exactly is the deal with that?
That's an excellent catch. So the deal is expected to close in Q3 of 2026. But intense antitrust scrutiny is basically guaranteed here. If regulators step in and delay the closing past September 30, 2026, WBD shareholders will receive 25 cents per share for each quarter the deal is delayed, measured daily. It's essentially a yield. Think of it as a penalty fee that Paramount pays to investors for regulatory construction delays. It shows that Paramount is highly motivated to get this concrete poured fast, and they're fully willing to compensate shareholders if the government decides to hold up the permits.
Moving on to Section 2, the load-bearing pillars. Let's talk about WBD's Q1 strengths. To really understand why Paramount wants WBD so badly, you have to look at the reinforced steel that's actually holding this company up. And the data here is impossible to ignore. In Q1 2026, WBD's studio segment saw an adjusted EBITDA jump of 156%, excluding foreign exchange. That hits $775 million. That is a massive year-over-year increase. And their streaming segment, adjusted EBITDA grew 17% to nearly $440 million. Okay, I have to acknowledge a 156% jump in the studio segment is absolutely an ironclad support beam. You're seeing real, tangible margin expansion there and a total turnaround from where they were just a couple of years ago. But what exactly drove that massive influx of cash? You don't just magically generate that much EBITDA without some major structural catalysts hitting the market at exactly the right time. Well, the catalysts were massive content victories. These are the heavy lifters. Warner Brothers Motion Picture Group won a record-tying 11 Academy Awards this year, including Best Picture for One Battle After Another and Best Actor for Sinners. And that critical success translated perfectly into hard commercial success. They delivered absolute global tentpoles like a Minecraft movie and the new Superman, fueling a global box office haul of over $4 billion just for their recent slate. Okay, fair enough. So the theatrical side is definitely pulling its weight. But what about the streaming infrastructure? Is it actually holding up? The streaming pipeline is flowing at maximum capacity right now. A Night of the Seven Kingdoms debuted to 36 million viewers. The Pit Season 2 pulled in over 20 million viewers per episode. But strategically, the biggest structural upgrade was actually completing the international rollout of HBO Max across the UK, Ireland, Germany, and Italy. Let's break that down for the audience. Why is that international rollout so absolutely critical to their ad-supported revenue? Because launching in these European territories isn't just flipping a digital switch. You're talking about massive localized marketing spend, negotiating with complex regional telcos, and adapting to very strict European ad regulations. But once you break ground and establish that footprint, you significantly lower your overall customer acquisition cost. This infrastructure completion directly forged an 8% increase in subscriber-related streaming revenues. They are adding highly lucrative ad-supported subscribers globally, bringing in fresh top-of-funnel cash flow, and on top of that, their distribution revenue is up 7%. These strong, highly profitable segments are exactly the load-bearing pillars that Paramount is paying $31 a share to acquire.
Section 3. Foundations Cracks. It's time to talk about the bleeding segments.
I am taking control of the narrative right here. You've shown us the shiny new penthouses, the streaming growth and the studio hits, but I am completely refusing to ignore the structural damage in the basement. We have to juxtapose that streaming growth against the legacy cable business. Because while streaming revenue grew 7%, global linear networks revenue dropped a brutal 9%. Is this legacy cable business structurally rotting from the inside out? Because look, you can build the greatest streaming platform in the world, but if your linear networks are completely collapsing underneath it, the whole building shakes.
Look at these linear network headwinds. $4.4 billion in revenue, down 9%. $1.6 billion in adjusted EBITDA, down 10%. They are openly admitting in their own filings to continued domestic linear audience declines. The cord-cutting axe is swinging hard, and advertising dollars are fleeing legacy television faster than ever.
Okay, I will defend the linear cash flow here because it's not completely dead wood just yet. Despite the revenue drop, generating $1.6 billion in adjusted EBITDA in a single quarter is still massive, massive cash generation. And why does it still generate that much cash? Because the fixed costs for these legacy channels are largely sunk and affiliate fees from cable providers are locked into long-term contracts. It acts as an incredibly potent cash cow, even while in decline. Plus, you have to look at the bright spots. They had 18 million viewers for the NCAA March Madness Championship game on TNT Sports, the most viewed in their entire history. And CNN viewership minutes actually grew 30% year over year. There is still massive reach and relevance there holding the line.
I absolutely dismiss that completely. A few good sports broadcasts and a cyclical election year bump in news viewership is literally just putting a fresh coat of paint on termite-eaten wood. The tension between declining revenue and high cash flow is a short-term illusion. The secular trend here is totally irreversible. Linear TV is a declining asset. Those long-term affiliate contracts will eventually expire and be renegotiated at pennies on the dollar, and Paramount is inheriting all of that structural rot.
Section 4. The $33 billion wrecking ball. Let's look at WBD's debt load.
All right, big tone shift here.
We are now on high alert as we move to the balance sheet to inspect the heaviest load bearing down on WBD's structural integrity. This is where the deal either gets reinforced or gets entirely demolished. I am dropping the hammer right now. $33.4 billion. That is WBD's gross debt figure at the end of Q1 2026. In a macroeconomic environment where interest rates are punishingly high, servicing this massive amount of debt is a wrecking ball swinging directly at the combined company's future free cash flow.
Market Skeptic. $33 billion? Unbelievable. And remember, we started this entire explainer by talking about a $2.9 billion quarterly net loss. I really demand a granular breakdown of how a company bleeds that much cash in 3 months while simultaneously carrying this kind of debt. Okay, let's look at the ledger. Here are the core cash flow drains. First, their underlying free cash flow was a negative $476 million, which was driven heavily by upfront content investments and the typical seasonal timing of working capital. But the absolute massive red flag on the ledger is this: a $2.8 billion Netflix termination fee sitting right alongside $1.3 billion in amortization and restructuring charges. Stop right there. This is exactly what we need to dig into. Why on earth did Paramount pay a $2.8 billion termination fee to Netflix on WBD's behalf? Explain the road not taken to the viewers. It's the cost of clearing the lot before you build. According to the SEC filings, WBD was exploring a wide range of alternatives to deliver shareholder value because they were just absolutely desperate for scale to survive their debt load. It is heavily implied they were in deep negotiations or even had a preliminary framework for a Netflix merger that would have combined assets. Think about it. A Netflix merger would have combined WBD's premium HBO catalog and linear reach with Netflix's unmatched global distribution algorithm and tech stack. Wow. So Paramount had to actively outbid the biggest streaming giant on the block? Exactly. When Paramount Skydance came in with this $31 per share cash offer, they had to break that existing Netflix arrangement. So under the merger terms, Paramount paid the $2.8 billion breakup fee directly to Netflix. Now, it's refundable to Paramount if WBD decide to terminate for a superior proposal, but it immediately hit WBD's Q1 net loss ledger. It is a brutal, multi-billion-dollar upfront cost just to secure the property rights. Now, let's look at the actual mechanics of the leverage. Right now, WBD's net leverage ratio sits at 3.4 times. That's calculated by taking their net debt of roughly $30.1 billion and dividing it by the trailing 12 months adjusted EBITDA.
Listen, 3.4 times is already an incredibly heavy burden. But the merger filings state that at closing, the new combined Paramount WBD will have a synergized net debt to EBITDA of 4.4 times. 4.3 times! That's insane!
That is the iron financial hard truth right there. At a 4.3 times debt to EBITDA ratio, the credit rating agencies put you on an immediate watch list. It drastically impacts your operational flexibility. It means every single free dollar of cash flow basically goes to servicing interest payments to bondholders instead of creating the next Game of Thrones, investing in streaming technology, or paying out dividends to shareholders. Management claims they have a clear path to investment grade within 3 years, but that aggressive capital structure leaves absolute zero room for error. If the broader economy dips, or just a few blockbuster movies bump at the box office, the whole structure could collapse before they ever reach that 3-year mark.
Section 5. The Iron Financial Verdict. It's time for the final call.
We've inspected the blueprint, we've tested the load-bearing pillars, we've documented the cracks, and we've weighed the wrecking ball. Now let's look at what management claims versus reality. Here is the carefully crafted corporate PR spin from Paramount CEO David Ellison. Quote, "By bringing together these world-class studios, we will create even greater value for audiences, partners, and shareholders." Market Skeptic. Oh, come on. I am aggressively tearing that corporate spin apart. We have seen this exact playbook before. AOL, Time Warner, anyone? I don't doubt the inherent cultural value of a combined film library of 15,000 titles, or owning Harry Potter, Lord of the Rings, and the NFL broadcast rights all under one roof. That's great. But you have to weigh those $6 billion in synergy promises against the brutal, historical reality of media mergers. Promises of synergy almost always result in massive upfront restructuring costs, chaotic management clashes, and severe stress on a highly leveraged balance sheet. They are building a fortress, sure, but they are building it on a foundation of dying linear networks that are actively bleeding out.
So, it's time for the definitive iron financial verdict. Is this $31 per share buyout a reinforced steal opportunity, or is it a rusted trap masked by Hollywood hype? Here is the call. For current WBD shareholders, this $31 all-cash offer is an immediate, incredibly fortunate bailout. It's a premium that allows you to extract your capital from the structural risks of cord cutting and a completely unsustainable debt load. The safest play for the retail investor holding the stock is to take the $31 in cash and run. Now for Paramount, they are indeed buying an incredibly strong IP foundation. They get a revitalized studio pumping out hits and a globally scaled streaming platform in HBO Max. But they are bolting a massive multi-billion-dollar debt anchor to their own ship. If their management team cannot execute those complex tech integrations and slash costs perfectly, this new megastructure will completely fracture under its own leverage.
And that is the ultimate takeaway for you, the retail investor navigating this extremely volatile market. This massive merger proves that in today's brutal media landscape, you either have scale or you get crushed by the tech giants. WBD had great IP but simply carried way too much debt to stand alone. Paramount is risking its own balance sheet to build a fortress big enough to fight back. So look at your own investments right now. Is your portfolio built on a solid, reinforced foundation of free cash flow and growth? Or are you blindly buying into condemned properties, desperately hoping a bigger developer comes along to bail you out? Lead Analyst, forge a stronger portfolio, cut through the market weakness, and whatever you do, never ignore the cracks in the foundation. Thanks for joining us on this deep dive. Stay focused on the numbers, and we'll see you on the next inspection.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.